Hi, you're watching Investor Insights, and in this video I'd like to talk about Warren Buffett's 4 rules in picking companies. Now, as you know, Warren Buffett is the world's richest investor, and this guy didn't get to this amount of wealth by making stupid investment decisions. So we can say that in his 6 decades of picking winners, we can safely say that he's got the art down pat. Now, let's take a look at these 4 rules. The first is that the company must be stable and its business must be understandable. The second, the company must have long-term prospects. The third is that the company must be run by vigilant managers. And the fourth is that obviously the company has to be undervalued. Now, the first important rule that he always sticks by is that he has to understand the business and how the business makes money. You can't invest in a company like Enron, for argument's sake, where the CFO was once asked how the company actually makes its money, and he shrugged his shoulders. So if the CFO, if the chief financial officer doesn't know, what chance in hell do you have of trying to work things out? The company has to be stable in the way that its income is consistent and growing. You don't want a company that has long spouts of growth or lack of growth. You just don't want to put large amounts of money into something that's erratic. The second point was that a company must have long-term prospects. And again, this goes without saying, because if you had all the money in the world and you were to buy out a company outright, you have to be expecting a compounding rate of return for your investment onto the business. So this thing's got to grow either organically or through acquisitions, and you've got to be able to pinpoint those 2 aspects when you purchase the company. The third point is that the company has to be managed by very diligent leaders. And the CEO of a Fortune 500 company has got to learn to steer its workforce of, who knows, 20, 30, 40,000 plus strong team members. He's got to work out how the company is going to make its next buck, how the company is going to grow, how to protect the company from the dangers of maybe a recession or unemployment or any other factors that's out there. So, as I said, the management must be very, very skilled. And the fourth point is that a company must be undervalued. And as I've always said, all investments are good provided you pay the right price. So it doesn't matter how well your company fits the first 3 conditions. If it's overpriced, it's not worth the capital outlay. So before you pick a stock, sometimes it's worth treating the stock like a company that you're going to buy outright. That's what I've been saying all along. And if it works for Warren Buffett, I think you can use these 4 rules just as a simple guide to steer you in the right direction.